Okay, good afternoon, everyone, or good morning. No respect. Could I have your attention, please? Attention, attention. So before we get started, has everyone scanned the QR code? Does anyone need help scanning the QR code so you can access the presentation? So you don't have to see it up here. You can see it on your phone, and then you can take it home and enjoy it at your leisure over and over and over again, if you prefer. Okay, yeah, go ahead, Mike. Get up there and get that. So, there's one on the table, but Mike wants to get up there close and take. There we go. Hopefully that pulls up. And we were just talking about our panel discussion that we typically do later in the year. Did you get it?
Got it.
Perfect. We're gonna do like a survey function, so make sure to bring your phones so you can answer the questions as we move forward. So thank you for coming out today, for everyone. So today we're going to talk about the stock market, bond markets, the economy, kind of our outlook, portfolio positioning, and then Jonathan's going to come up and talk about the new act that Congress passed, which made an incredibly complicated system even more complicated, which you'll find is a perfect opportunity for financial advisors and CPAs to help you through the process. So he's got a few slides on that. So let's go ahead and get started. Now, I guess before we start, Ashley, thank you very much for putting this together. We did make a few adjustments based on comments last time. I think the screen was definitely hard to see. And then we put the QR codes on your tables as well so that you're able to access the presentation. Disclosures, everybody read that? So the title of this portion of the presentation is Recession with a question mark. And that's a big topic, obviously, of discussion. And what we want to focus on today is, first of all, look back at what happened in 2022, but then talk about the future and talk about the likelihood of a recession and just as important, what a recession might mean for portfolios. Okay, so far this year, stocks are up 7, bonds are up 3, and you know what? Honestly, maybe we should just end there and everyone can enjoy lunch and we just go home. That's 3.5 weeks, right? So look, that's pretty darn good returns. When I finish this, you may think, well, just put me all in cash and I'll take that and forget it for the rest of the year. But it also points out the fact that anyone who decided at the end of the year that I don't really think I need to be in stocks and bonds, the year was too painful, there was too much volatility or whatever, that's what you missed out on. That 3% return on bonds is more than you've made in 3 years in bonds, right? Pretty amazing that just a small decrease in interest rates, which we'll talk about today, can result in large increases in bonds. The stock market, who knows, like short-term predictions are incredibly difficult, but we've seen a rebound in a lot of different types of stocks. And a lot of the more speculative companies have done extremely well. So portfolios, if you look at your portal now, it's much more pleasing. You'll be much more satisfied in terms of the kind of the panel over to the left that shows year-to-date returns. And then if you actually, for most clients, we've had several meetings here recently, if you look at over the last year, losses on portfolios are single digits. So we've been able to overcome some of the more significant losses that we saw last year. At the last luncheon, I believe Cliff Kavanaugh asked about a quote. So I added another quote because I think it's relevant for some of the things that I'm going to talk about. So people do not get what they want or what they expect from markets. They get what they deserve. Which another way to think about that, I was thinking about this morning, it's, karma is a bitch, right? It's essentially what that means. If you expect to get rich in the stock market, if you think you're owed that, if you think that somehow you have insights that others don't, generally you pay for those things. And what we see during certain times in the market, and this is going to be perpetual and it will outlive me and it will outlive everyone in this room, is that people's emotions overcome them and basically greed and fear take over in terms of making decisions. And we certainly saw that in areas of the market post-COVID in 2020. in 2021, and a lot of that was given back. So when I talk here initially about 2022 performance, people kind of got what they deserved in a lot of cases. So last year was a terrible investment environment for what most people own, stocks and bonds, right? I mean, that is generally 95% of everybody's portfolio. Anybody's 401k portfolio, stocks and bonds. Most advisors' portfolio, stocks and bonds. The first 5 categories are stocks and bonds, all down double digits. There's no place to hide. It didn't really matter what kind of stock you own, what kind of bond you own, you lost money. There were areas of the market that actually did well, and all of you own them. And you can see here reinsurance was up 5%, and trend following, which is essentially looking at buying things that are going up and selling things that are going down, we're up 23%. So we call these alternatives. You're all familiar with them. Last year was a banner year for alternatives. It's not always a banner year for alternatives, and certain years people will question why we would ever want to own an alternative, but that's just the way investing works. Sometimes you look really stupid, and you almost have to in order to have years where they added to portfolios. So it was a positive to own alternatives. On the other hand, it was terrible for just about everything else. Red is bad here. This is like showing different stock categories and bond categories. The only green you see was the dollar was up and a few commodities. Once again, everything was down. Kind of getting back to what you deserve. So for 10 years, the simple investment strategy that a lot of people employed was to buy growth stocks, to buy Amazon, to buy Apple, Meta, Facebook, Google. One decision stocks, you can't go wrong. Everyone loves Amazon. Everyone uses Amazon. Fabulous company. What happened to Amazon last year? It lost 50%, $1 trillion in market cap. In fact, last year you can see in this little 3x3 is that growth, large growth stocks, which are those companies that I just mentioned, down 40%. So the best place to invest for the last year was the worst last year. This is the way markets work, and once you are convinced that the companies that you own are the best ever and can't go down, they do. On the other hand, value stocks, which we'll talk about today, which have done very poorly for the last 10 years, had a very good year. Some of this is tied to energy. Energy was actually a significant outperformer last year. But we saw a large rotation, is the idea here. There was also, if you recall, post-COVID into 2000, beginning of 21, there was huge discussion and excitement about meme stocks, which were going to be like GameStop. They were going to be like cool companies that did like cool stuff that take over the world. There was also a lot of discussion of cryptocurrency, and it went straight up. And there were a lot of punk 22-year-olds getting rich and posting stuff on social media about how they were really smart. And there were people retiring and calling themselves day traders, and they thought they were really smart because they just bought stuff that went up. But you know what? Everything went up. You didn't have to be really smart to buy it. It went up. Well, guess what? As we would expect, those types of companies, Bitcoin actually is down more than 50, but those types of companies are down 50%. So, and of course, usually when we show charts like this, most people who were buying these types of companies weren't buying them down here. They were buying them up here after they finally convinced themselves that this was the truth and I needed to own them. And consequently, they're all down substantially. And whether they've held on or not, who knows. But now these companies have all rebounded kind of at the end of the year. But the thing is, when you go down 50%, even if you go up 20%, it's not very much, right? It takes a lot to get back. It takes 100% to get back. And then my favorite kind of meme stock investor is Kathy Wood. We've mentioned her before. She runs the ARK fund. I'm not really sure how she picks stocks, but she's not very good at it. But she attracted $30 billion and now has evaporated $20 billion. So her fund, which we've mentioned before, was up 300% on the way up here, 357% you can see. From the peak is now down 81%. So in fact, now Kathy, if you invested with Kathy back in 2018, you broke even. So 5 years you broke even, you're trailing the S&P. Anyone who bought this fund, which were a lot of people, I mean, this was literally billions, tens of billions of dollars, kind of got what they deserved. So fortunately, WJ investors didn't own the ARK fund and never would own an ARK fund or something like it, because these stories don't end well, and they usually end exactly like this. So we've talked about this in our last WJ notes, which we wrote at the end of the year. It was a bad year for stocks, but it wasn't the worst year. So 2022, you can see that 74 and 2008, 2002 were worse years. But for bonds, it was a terrible year. I mean, a year, almost an unprecedentedly bad year. The amount of money lost in bonds, this goes back 30 years, but you could go back hundreds of years, and it's very rare to lose that much money in bonds. And the reason which we're going to talk about is obviously interest rates, but it is the case that the reason you own bonds is so that they potentially stay flat or go up when stocks go down. That's not what happened last year. They all went down. And in fact, if you take a portfolio where you balance the two, where you own the two, which is basically what most people own in this room with some alternatives thrown in, fortunately, you combine the two, since they both went down pretty dramatically, it was the worst year since 1920. Well, not the worst, the third worst, I guess, since 1920. We have to go back to the Great Depression to see years where you lost more money in kind of a balanced portfolio, which made it unusual. And as I said, this is everybody's typical portfolio. There's, I don't know, $6 trillion invested in 401ks. They're in what we call target date funds. Target date funds are stocks and bonds. So anyone who had a 401k, which is basically where everyone's invested now, was kind of down in this range. As I mentioned, though, alternatives were up last year, and our portfolios weren't down this much. But the idea of and I'd also say, I guess I'd emphasize that, say, the last 20 years, 60-40, kind of putting your money in some stocks and some bonds was a fabulous way to invest. And we're not really going to talk about it today, but you could make an argument that maybe the next 10 years will look a little bit different, that just kind of the simple kind of stock and bond mix is not going to perform the way that it did. So I put this chart in here just to give you a sense of what's happened since COVID. And, you know, this is the funny thing about the way markets work and history works. You only see one outcome, right? You don't know the counterfactuals. You don't know the way that it could have gone, right? And it's kind of fun to speculate. But basically what's happened is we had this huge COVID sell-off, right? Which was when we figured out that, hey, this thing is real, and and we're going to shut down the economy, and everyone's going to stay home, and et cetera, et cetera. And then we had the government's huge reaction to it, spending $6 trillion and sending money out, and you know, basically paying people to stay home. And the market reacted very positively to that stimulus, and stocks went way up. They were up 100% off the bottom, which is the blue. And they subsequently kind of gave all that back. So a balanced portfolio, which is the green, over this entire COVID period is about flat. Now, I guess if I think back to the beginning, say January, when we learned about COVID, and when we started to understand the implications of it, and when we started to close businesses, and we told hundreds of millions of people to stay home, both here and globally, if I said to you, you know, over the next 3 years, stocks, I don't know, balanced portfolio would be about flat, a lot of us may be like, well, that's not too bad, right? That'll probably be okay based on what you just explained in terms of what could happen here. And that's what's happened. But you could also make an argument, like I said, like a counterfactual. What if the government really did nothing and let things fall to 50% and then kind of recovered and got back here? Maybe it'd be in the same position. So a lot of what we're seeing in terms of the way that the stock market and bond market reacted and the economy reacted is because of a combination of the COVID, but then it's the reaction of the government to COVID, okay? And as we move forward here and we start to talk about the Fed, which is essentially a government actor, and their influence on stocks and bonds is pretty dramatic. I did show, just to give you a sense, the alternatives once again. So managed futures, which is the kind of yellow line there, you can see actually outperformed. It was the best performer during this period. And once again, it didn't really matter too much if you're in stocks or bonds. They both ended up essentially in the same place. So what's caused all this? It's inflation, right? We know inflation's been pretty pervasive. I would point out in this chart, though, that you can see the dramatic rise, but you can also see, and it's not insignificant, the drop in inflation recently. And you can see that it's really been a couple areas where inflation's fallen pretty dramatically. So energy, for sure, and we just know this from gas prices coming down. But core goods, so core goods, the purple area. The purple area is like stuff that we buy. Well, what happened during COVID? Like, you stay home, you can't go out, you can't travel, which is all service-oriented stuff. You can't go to a restaurant. And you just buy stuff on Amazon. And what is that? That's like goods that are made everywhere. And so what happens? Like the system falls apart, right? We're not capable of producing more toilet paper or whatever in a short period of time, and prices go up to reflect that so that it offsets demand. And so goods rose dramatically, but I think we're starting to come back to more normal levels because the influence of COVID and that extra money and people staying home have gone away. But what has not gone away yet, and this would be most concerning going forward, is core services. Core services is the most important one is rental, is housing, let's say. So whether that's rental or owner's equivalent rent or whatever, it's a housing component. The argument for that not going down yet is it's the way they measure it is there's a lag between what's actually occurring and what they measure. So some argue that services definitely will come down in the future. But look, inflation started to come down, and our base case is it continues to come down. And you may recall that I think Brandon had shown an example of an outcome if inflation was relatively low or flat, maybe rise a little bit for the next year or so, that within 6 months or a year, inflation's at 2 or 3%. This is certainly a possibility, right? And that's what the Fed is trying to achieve. Now, we're going to talk today about whether you think the Fed is the reason that it's come down or it would have come down anyway, but we could be in a much more favorable, we already are approaching a much more favorable inflation situation. So I put this in there because it was interesting. We were talking about inflation. So this is, you may have seen this is a meme. For y'all that are a bit older, a meme is kind of like a joke that they post in social media. Where's Bill? I don't know where he is. Well, he knows what a meme is. Anyway, so in 2020, if you were rich, how did you demonstrate that to people? Guess what you had? You had a lot of toilet paper, right? You loaded up on toilet paper. And then in 2021, as I said, like the thing that was cool and that everybody wanted to buy or own or whatever that demonstrated it was Bitcoin and Ethereum. And then last year, in the beginning of the year, it was gas, right? Gas prices have gone crazy, and you loaded up on gas like these people are doing and put it in the back of your car and sold it to your neighbors. And in 2023, here at the end, this is inflation is eggs, right? I actually don't know what a carton of eggs costs, but it's a lot more than it used to be. Let's just put it that way. That's what I've heard. I don't know. I don't buy eggs, but so anyway, I just thought it was funny. I thought there are some areas that we've seen that inflation has not abated. Now, of course, I don't know the reason egg prices are up. Like I think I saw on Twitter somebody claimed it was because the egg producers are taking advantage of inflation and trying to inflate their profits. Or it could be avian flu. I don't really know. Probably the avian flu seems more likely, but there's been a lot of discussion why egg prices are up. But it's demonstrative of a situation that prices have risen dramatically. Okay, so I want to focus on this chart because this is really important. So so we have inflation, right? And the Fed's job is to fight inflation, is to keep inflation at a reasonable level. They pick 2%. They want 2% inflation. That's their target. It's also their job to make sure everybody has a job, okay? And those two can sometimes be contrary to each other, right? So the idea of inflation getting too high would mean maybe the economy is too strong and too many people are working, so they want to potentially raise rates to slow the economy and slow inflation. So what we saw last year was a dramatic increase in the Fed funds rate, which is what the Fed controls. And they're doing this to bring inflation down. And this is very short-term money. This is like a 3-month treasury bill or a CD, let's say. The market-based rates, which are the blue and the red, are not controlled by the Fed, and they're controlled by the market, essentially. But look, they're tied somewhat to what the Fed funds rate is. So what did we see last year is we saw a dramatic increase in the Fed funds rate that the Fed controlled, and then we saw market-based rates go the other direction, or go the same direction, right? They all went up, and they all went up a lot, and that's the reason that your bonds lost value. Your 1 or 2% bond, say you owned a treasury that was paid 1 or 2, at the beginning of the year, at the end of the year was at 4. So if a bond pays 2 at the beginning of the year and at the end pays 4, same bond pays 4, it's worth less. The value of it has to go down, and that's what happened. We've discussed this with many and will continue to argue that that loss is temporary and you can recapture it if rates go the other way or if yields stay higher. I do want to point out, though, that when the Fed, and there's an important takeaway from what we're talking about today, when the Fed increases rates, and the first increase was in March of last year, it could take anywhere from 6 to 12 months for the full impact of the increase to be felt in the economy. The description I've heard is a long and variable lag. Your Federal Reserve Chairman describes it the same way, which means when they do it, the impact is not felt for months, maybe years. And so here we are in January, right, of 23. What was the interest rate in January of 22? Fed funds rate, it was 0. They hadn't even started to increase rates yet. So when we talk today about trying to predict what the economy is going to do and what the impact of Fed rate increases are going to be, there's a lot yet to come. I used the analogy last time, which I'll use again, of the Fed turning the dial on like a stereo, the volume dial, and turning it like more and more up, and nothing really happening to the sound. But eventually, the sound, there's a lag, the sound starts to increase. I would argue right now what the economy is experiencing is not near what could come. There's a lot more coming. In addition, the Fed's not done. They're still going to increase rates this year, which would mean those impacts might not be fully felt for another year. So I'm not going to make a prediction about whether we're going to have a recession or not. I'm going to talk to you about why we think it actually doesn't matter too much in terms of portfolio positioning. But anyone who does is assuming they know what the impact of all of these rate increases will be, plus future rate increases that haven't even happened. I don't know how anybody can do that consistently, right? I mean, they can try, but I'd be very skeptical of those predictions. So as we move forward, though, you can see these start to, there's certainly some impact, but in housing and maybe other things, but the full impact won't be felt. And the full impact won't be felt until almost 24. So when we talk about a recession in 2023 with a question mark, it could be a 2024 recession, potentially. So I mentioned already, this was one of the fastest increases in rates we've ever seen. You can see in the past, at least, they've never increased rates this fast. Once again, so we're dealing with an unprecedented increase in rates and then trying to guess what the impact on the economy will be. Very difficult. This is not just U.S., this is throughout the world. The world is facing inflation because of COVID and government reaction to it. So you see it throughout the world. They're all increasing rates, and rates are back to levels that we have not seen since 2008, which is a good thing for an investor. Remember that, but it has a negative impact initially on bonds. So I mentioned already, like the Fed, the idea is the red is what we anticipate what the Fed plans on doing. So they're not done increasing rates. They're like at 4.5 now. They've said they're going to increase a couple more. And they've said, like, we're going to increase rates to, say, 5, and we're going to leave them there. Okay, so that's what the Fed said. What does the market say? The market says, yes, we agree that rates are going to come up, but we think that actually, starting mid this year, rates may start coming down. And this is important, okay, because what happens to rates is going to drive the returns on bonds and then drive the returns on portfolios. The market is questioning the Fed's commitment to keeping rates very high, right? And so once again, trying to predict a recession based on what the Fed says they're going to do, which we don't know for sure, and then what the market says they're going to do. We just don't know the future path of interest rates, and once again, that's going to drive returns on bonds, but also is going to drive what the economy ends up doing. Okay, so is a recession coming? And I'm going to show you, I think, 5 charts here that all look somewhat similar, and I'll go through them relatively quickly. And just when I show you a chart like this, down and to the right is bad, okay? So generally, when we see down and to the right, this is what are called the leading economic indicators, we end up in a recession. That's the gray bars. So when you drop below this level, historically at least, when you look at these measures, it leads to a recession every time. There's not been a time that you've dropped below there where you haven't had one. So if you argue we're not going to have a recession, you're going to say this time is different. And these measures are things that are market-based rates. They're including the stock market, but they're forward-looking measures of the economy. They're not lagging measures, which are things like employment. They're forward-looking measures. So that would argue we're going to have a recession. These all dropping below 0. So this is consumer confidence, it's industrial demand, it's retail spending, it's housing. I'm going to show you another housing. Those would all argue that we're to a level that would generally indicate a recession. Not maybe that we're in one, but one is coming. I mentioned home sales. Okay, so December, existing home sales down 36%. This chart goes back to 2000. That's the worst we've ever seen since 2000. Worse than 2008. I don't have the recessions on here, but that was a recession for sure. This was a recession back here. So there's been a dramatic decline in housing. One of the primary and the first impacts the Fed has by increasing rates is on housing, right? I mean, mortgages rates have doubled. So your ability to buy a new house, it costs you twice as much. Brandon's actually buying a new house. We were talking about mortgage rates. I think it's double the price, like because of the increase in mortgage rates, and in addition, housing prices have gone up 20%. So what do? I mean, if you have a 2.5% mortgage, you probably just stay put, right? You don't move, and we've seen that. And the Fed knows that. That's an influence. But remember, that's not just like selling a house. It's like anybody who's bought a new house. What do? Well, you have to pay the movers, and then you have to go to Home Depot to fix up stuff, and you got to do the yard. I mean, there's those ancillary benefits and jobs and economic activity tied to home sales that have changed pretty dramatically. So that would, I think, would be obviously arguing that a recession's coming. This is earnings revisions for the S&P 500. So this is all 500 companies in the S&P. We take all their earnings together, and analysts guess at what they think they're going to be. They generally do okay in terms of guessing. It's not perfect, but they're all assuming that earnings are going to fall, which just means companies are going to earn less money. Historically, when that's happened, it's been a recession. So I could show you some charts that would not indicate a recession, like employment's not gone up. My argument for that is not yet, right? We've talked about this lag. Employment has not gone up. That's generally the argument that why we're not in a recession, we might not have one, because people haven't started to lose jobs. We'll wait until all of the impacts of the past and future increases start to influence the economy, and it definitely could lead to a recession. So our guess is we do have a recession, and predicated or important to that guess, and what I'm going to talk about next, is that we continue to have disinflation. Look, all bets are off if inflation for some reason spikes back up. That's going to be terrible for bonds and terrible for stocks. It's a very unlikely scenario, at least, and markets certainly aren't pricing it in, but if that's the case, so a low probability scenario, it's going to be definitely a challenge for any investment. But assuming that inflation slowly comes down, I don't know, basically where it stops or what level it stops at, and we have a recession, what does that mean? Oh, so this is just kind of supporting that idea of like, we had like 6 months of, this is year over year, like inflationary, month-over-month inflationary increases, right? So we're 1 month percentage change, I guess is the way to describe it. Each month in December, January, this is how much inflation was going up. Well, look what happened in July. 0, and then August. So if I take those last 6 months and I kind of average them together, and I assume the next 6 months look like that, those 6 months, inflation's probably 2%. It's almost non-existent. It's right where the Fed wants. Now, obviously, if I take, and remember, when I'm measuring inflation, I'm adding all these up, and I'm adding a new month and subtracting an old month. Well, what am I subtracting? I'm subtracting like these huge increases. And this is the reason inflation's coming down, and you could easily make an argument that in 6 months it's quite low. The thing is, when I look at this chart too, is I wonder to myself, like, so we looked at what the Fed did. They didn't really start increasing till May. And if the impact of all the Fed increases takes 6 or 12 months to impact inflation, then maybe these pretty dramatic decreases in inflation had 0 to do with the Fed. And I think you could make a pretty strong argument that the Fed had no influence. The Fed initially said inflation was transitory. And you know what? They backed off that when this stuff started to happen. But maybe it was. Maybe in a lot of cases it was. Maybe oil prices got way too high because of Ukraine and came back down. Maybe all of supply chain issues have been, a lot of them have been worked out. Maybe people's buying patterns have gone back to normal from the way they were before COVID versus COVID. And so maybe a lot of the inflation was going to go away anyway, which means maybe what the Fed's doing now, and we haven't even felt the full influence, maybe they've done too much. Maybe they don't need to do more. And I think that's a reasonable argument to make. So let's talk about a couple of scenarios, because like I said, like, we have a recession, but I don't know what that really matters other than we have a recession. It matters for your investments, okay? So I'm going to just talk about 2 scenarios. This is a little hard to see what we're looking at here, but this is essentially the Fed funds rate. I think we kind of looked at this earlier. Under this scenario, let's assume that the Fed funds rate goes up and maybe goes up a little bit more and then stays flat. We have a recession, but we'll call it a soft landing. It's minor, okay? So maybe unemployment goes up 0.5%. The Fed basically leaves rates up here at 5. Stocks probably do okay. And there's no reason for stocks to dramatically decline in this scenario. Earnings are okay. We could contrast that with what we'll call a hard landing scenario. Once again, inflation declines, but the recession is more severe, right? In this circumstance, the recession, maybe we have 1 or 2% increase in the unemployment rate. A lot of people lose their jobs. Under this scenario, the Fed is not likely just to sit there and leave rates where they are. So they've increased rates to 5%, let's say. Let's say 9 months from now, unemployment's now crept up 1%. Politicians are going to be clamoring for the Fed to do something. People are losing jobs. Inflation seems to be down maybe to 3 or 4. What do you think the Fed's going to do? I mean, and what does the Fed usually do? They only do one thing. They manipulate interest rates. They're going to be cutting rates. And is there any precedence for that historically? Yeah. So every time we've seen dramatic Fed increases, this is the Fed funds rate, the Fed doesn't sit there and leave it for 6 months or 12 months or 18 months. On average, within about 7 months, they're going the other direction. So here, these are the time that they leave rates alone before they start cutting. 5 months, 8 months, 15 months. Historically, they're cutting rates. They don't wait, and they're cutting rates because whether they drove us into a recession or we're in a recession, they're trying to offset the impact of past rate increases. So under this scenario, on a more significant recession, we think the Fed probably cuts rates, and that could be starting this year. But also under this scenario, of course, stocks do decline. Companies lose money, people are losing jobs, and the stock market declines pretty significant. So let's kind of put that together in terms of numbers. And no one take a picture of this, and I put down here, this are just guesses. These are not my predictions. This is just to demonstrate for discussion purposes. This is what happened last year. Bonds down 12, stocks down 17, so your balanced portfolio was down 15. If you threw in alternatives, maybe you did a little better, which we did. Under a soft landing scenario, bond yields today are about 6. Your bond portfolio pays a 6. So let's assume interest rates don't change because the Fed raises rates and just leaves it. And let's assume stocks, they do okay. I mean, they're flat, so they don't lose money, they don't make money. So if I just take 50-50, I make 3%. Dramatically better than what I saw last year, down 15. But let's take the hard landing scenario. What happens in a hard landing scenario? So stocks fall 20, which would mean stocks probably are overall down about 30%. Right now they're down about 10 from the peak, 30% loss. That's typical of a pretty significant recession. But what happens to bonds? So we earn our 6% yield, but we also get all the money back that we lost last year when interest rates went up because interest rates are going down. The Fed is cutting rates. And we make double digits on our bonds. And if they go down enough, if they go back to where they were post-COVID, this number could actually be 20%. So you add those two together, 50-50, guess what? Your portfolio's down 3%. So in our minds, do we have a recession or not, it doesn't make a heck of a lot of difference, right? In the magnitude of the recession is somewhat unimportant. The key to where we sit today, and the most important thing to take from today, is that bond yields are dramatically better than they were, and the more that the economy slows and the worse the recession is, the more likely it is that the Fed goes the other way and decreases rates, which increases the value of your bonds and increases the return on your bonds. So you get this kind of automatic offset, this is why the 60-40 portfolio has been so popular for the last 30 years, because every time that stocks went down, bonds went up. It's when interest rates got to 20% in 1982, every time that stocks went down, bonds went up because the Fed cut rates. The problem that we ran into last year is we got to 0. You couldn't cut them anymore. Well, guess what? We got them back up, and so now we can get some protection if stocks fall. And I have no doubt that the Fed, although they say we're not going to pivot, we're going to fight inflation, whatever, if there's enough, they're political, if there's enough pressure because people are losing jobs, they'll cut rates. And your bonds are going to make double digits in that case. So does it matter? I'm not really sure if it matters too much, the magnitude of the recession or necessarily even when it comes, because I think you're going to be protected. And I didn't even mention, we didn't put alternatives in here, but alternatives could have they're uncorrelated, remember, right? So it's hard for me to predict on this basis, but at least for strategies that are betting for or against interest rates, they actually could do fine in a hard landing scenario because what they're going to do is they're going to bet that interest rates are going to go down. Okay, so just to kind of emphasize this bond idea and our view that bonds are very attractive. We're overweight bonds in portfolios. We've been shifting for the past 6 months money into bonds from alternatives. So this is, just think of a bond, I don't know, bond value at the beginning of 22, say it was worth 100, and the yield on the bond was 2%, so you would expect to get $2 a year. Well, by the end of the year, the value of that bond was down to, say, 90, but the yield on the bond was up to 4%, so you still get the same $2. So what does that mean? Well, first of all, you definitely don't want to sell. I've had some discussions with clients who are like, don't put me in, get me out of bonds, put me in cash. The problem with that is if you put yourself in cash, you're locking in that yield, right? And so if interest rates go the other direction, you're not going to recapture it. But so this is a 2% bond over time, and how much money you make, this is a 4% bond. Well, look what happens. At some point, because you're earning 4 versus 2, the 4% bond overcomes the 2% bond. And in fact, assuming nothing else changes, does better over time. So you are better off accepting the capital losses last year longer term. Higher yields are really important longer term to bond values. And in addition, if rates fall, right, if rates go the other direction, then this starts to move this direction, and you can easily overcome the losses that we saw in 22 within a year. I mean, it could, by the end of the year, you make it up. So the opportunity set in bonds is the best we've seen in 10 years, and we're definitely taking advantage of it. As I said, though, just as a caveat, I'll just reinforce this. If interest rates for some reason go the other direction and go up, which could be because of inflation or some unforeseen circumstance, and that's going to be bad, right? We're betting that bonds are going to go down or stay flat. So that's certainly a risk, although we think that the risk of that happening is very low in comparison to them going the other direction. So we're definitely overweight bonds. We anticipate that yields likely stay flat or go down. Just to emphasize the point, this is measuring or adding up all of the bonds that yield more than 4%. 4% historically has been pretty good on a bond. Like most of us would be pretty happy with that. Well, what happened from 2010 post-financial crisis to 21? There was basically nothing. You could buy like emerging market. You had to take a lot of risk to get 4%. There was nothing you could buy. Prior to that, there was a lot of stuff you could buy. You could buy municipals, you could buy treasuries, safe stuff and get 4, right? Well, look where we are today, 22. We're kind of back to where we were in that area. It's just a much more attractive opportunity set for bonds. There's not a heck of a lot you can do here. The only thing you could do here, and we saw some people do this, and I think you know what, they got what they deserved. They took a lot of risk to try to generate higher yields, right? And those strategies tended to not do very well last year. And fortunately, we avoided it. It was hard to do because when your bond portfolio is only yielding 1 or 2 and it's kind of dead money, you're motivated to look for something to do better. But the things that added value during this time paid the price here. So let's talk a little bit about stocks. There's a lot of information on this chart, but I think the way to think about this is what we're looking at is what's called a PE ratio, which is like a price to earnings ratio. And just think of it as how much you have to pay for $1 worth of earnings. And the higher that you pay, the more expensive something is, right? So it's just like per square foot on a house, which I think is a good analogy. The higher that you pay, the more expensive it is. And the other thing that's tied to this is the higher the PE, the lower future returns. So you want low PEs when you buy stocks. You want to buy things that are cheap. Just like anything else in the world, stocks are no different. So what we're showing here is the green, which is 2021. So this was in 2021. What was the PE ratio of some different types of stocks? So let's start with the U.S. So in 2021, it was 22. The blue is kind of a more typical historical range. And the little gray square is kind of the median. So if you're above that, you're kind of overpaying. If you're below that, you're getting a bargain. Well, so U.S. stocks were expensive. But the interesting thing is they've come down a lot. We would argue they still remain expensive. They're still not exactly cheap. But look at European stocks. So first of all, they were a little bit expensive in 2021, but look at where they are now. They're below the historical range, and we would argue they're cheap. And interestingly, this year, you know what's done best is European stocks. And remember that, because every time I mention Europe, European stocks in general, people say to me, well, God, I mean, they're a disaster over there. Look at all the issues they have with oil prices and unemployment, and they're socialists, and like all this kind of stuff for reasons or whatever. Their stocks are cheap because everyone feels that way, right? It just means it doesn't take too much good news for the stocks to do well. And so there's opportunities there that we haven't seen in a while. This is Japan, same thing. This is Asia Pacific ex-Japan. Emerging markets, which aren't shown on here, are even cheaper. So they're probably like a 10 PE. So we are seeing potential future returns on stocks better than we've seen in 10 years. Okay, so I've talked about bonds, I've talked about stocks. Portfolio returns over the next 10 years are as good as they've been in a while. And just one other opportunity that we've seen, that we found. So as I mentioned, this is tied a little bit to what has done really well over the past 10 years. It's been growth stocks. And what we're comparing here are growth and value stocks. So growth stocks are going to be companies that have good prospects. They're the companies that everyone gets excited about, that thinks, you know, they're going to take over the world, Amazon, Meta, Tesla. Whereas value stocks are kind of the unloved stocks that don't seem that exciting, but tend to make money. They're just not as sexy. And so if you take like growth stocks divided by value stocks, you can kind of plot the valuations. And what's happened basically since 18 here is you've seen that growth stocks have tremendously outperformed. They've become much more expensive versus value stocks. And I guess the way to think about this is we're in the 94th percentile of the valuations of the two. Well, look what happened last time we got here. From that point forward, and this was the tech bubble, value stocks dramatically outperformed over the next 4 years. We think we could be in a similar environment. If history repeats itself, which it tends to do, this series is mean reverting to some degree. If over the next 3 or 4 years value stocks do much better than growth stocks, then that type of outperformance we can capture by owning value-oriented companies. And you'll notice we just bought another value-oriented fund to add to portfolios last week, I believe. But we've been adding to value positions in anticipation of this series kind of reverting back to the mean. And just to show you that in another fashion, 2020 was an awful year for value stocks. This is value versus growth. Growth stocks did fabulous, and many people piled in because of the performance in 2020. 2021 actually was beneficial for value by a little bit. 2022 was one of the best years ever for value, and we anticipate that continuing. So to summarize then, we think we're going to have we think inflation's going to come down. We think we'll have a recession, but we don't even know if the recession of the magnitude matters that much. We anticipate bonds doing very well for the year, stock likely struggling or going down, but the more stocks struggle, the more bonds will likely go up, offsetting any pain in stocks, which ultimately means that this year is going to look a lot different than last year looked, and performance should be much better. So thank you all very much. We appreciate coming out to discuss portfolios. And before we end, though, Jonathan's going to talk a little bit about what do we call it? Secure Act.
Secure Act.
Yes, ma'am. They're independent.
The question was, how tied is the Fed to current administrations? Very little. However, there is obviously some influence, as he mentioned before, with Congress pressuring them to do something about inflation in today's world.
But they're structured to be independent.
Yeah, they're structured to be independent. Doesn't necessarily mean it's completely independent, though. All right, so one of my favorite quotes is, money is like soap. The more you handle it, the less you'll have. So speaking of Congress, we'll talk about the Setting Every Community Up for Retirement Enhancement 2.0. 2.0. I will not talk about the proposed Pelosi Act that was just proposed, I think, yesterday. All right, so out of the hundreds of pages of the Secure Act, I'm really going to cover just a couple of ones that I think pertain to the broader audience here today. As we meet with you, we can certainly talk about your specific situation. But one big change coming up will be the required minimum distribution age. So the first year that you're going to have to take money out of a traditional IRA, those ages are going to change. Before, several years ago, it was 70 and a half was the required minimum distribution age. The last couple of years, it's been age 72. Starting this year, the new RMD age will be 73. In 2033, the new RMD age will be 75. So it's pretty significant changes, and if you fall into the category of, say, 73 or 75 now, and you haven't had to take distributions yet, there's certainly going to be some tax planning opportunities. You know, for this year, one of the things that we will continue to discuss, as we've discussed before, is Roth conversions, moving money from a traditional IRA to a Roth, paying the taxes on it now so that you reduce the amount of taxes you pay later. May or may not be as impactful for you if you fall into one of these categories. Another sort of nuanced change is for any surviving spouses that had IRAs or have IRAs that they will inherit from their deceased spouse. Normally, when one spouse passes, you just roll it into what's called a spousal IRA. So it's just an IRA in their name at that point. And then the distributions occur based on their age. There is a benefit now where if the surviving spouse is older than the decedent, then they can actually move it into an inherited IRA. And that would be more beneficial because then they can use the decedent's age as the RMD age, which would help reduce the amount that they're having to take out. And to keep it simple, this is what that looks like. So as we meet with you, if you're in that situation, we'll walk you through it and help figure out the best solution for you. The other thing that they've added for those that are still contributing to retirement accounts, for simples and SEP IRAs, up until this year, you were not able to contribute into a Roth. So nuanced difference between the two: a traditional IRA, you defer the taxes, you don't pay the taxes on the money that you put in for that year, versus a Roth, you pay the taxes and then the money goes in and then it grows tax-free and comes out tax-free when you pull it out. Before, you were not able to do a Roth contribution into a simple or a SEP. Starting this year, you will be able to do that. Now, it may take some time for custodians like a Schwab or Fidelity or some of these other custodians to actually catch up to the legislation and be able to do that. The good news is things like a SEP IRA, regardless of whether it's a traditional or a Roth, you really have until you file taxes for that year to make a contribution. So if you're going to contribute to a SEP IRA for 2023, you really have until 2024 when you file your 2023 taxes to do it. So hopefully by then custodians will be able to catch up with that. The other is employer contributions. So if you happen to contributing to a 401k for employer contributions, normally that match or even the non-elective just goes into a traditional, even if you are contributing to a Roth. Starting now, they can actually do that into a Roth. Now, keep in mind, though, that's going to be taxable income on that person's taxes if they elect that option. So another change is they call it a catch-up Rothification. So if you make over a certain amount starting in 2024, which the number is 145, your catch-up amount, which is basically the extra amount that you can put into an IRA or 401k, starting next year, that extra amount, if you're over age 50, has to go into a Roth. Well, why would they do that? Well, because they're spending our money so wisely that they need to generate the revenue earlier. That's part of the reason. And then one other change that was pretty interesting in this bill is 529s to Roth IRA transfers. So If you have a 529, you've been saving, let's say you set one up for your child or grandchild, and they don't end up using it, now the law, starting in 24, allows for you to basically take the money from the 529 and put it into a Roth. Now, the Roth IRA has to be set up in the name of whoever the beneficiary is. So, and that beneficiary has to have earned income. Now, there is nothing saying that you can't change the beneficiary to yourself. So if you have a 529, you can always change the beneficiary. You can change it from your child to yourself to another child or grandchild. But there's nothing in the legislation right now, as far as the implementation is concerned, that says you cannot technically change it to yourself as the beneficiary and then put it into a Roth if you want it. There are some rules with it that we need to be mindful of. There is a limit. You're limited to $35,000 in total per beneficiary contributions, but per year you're going to be limited to whatever the Roth limits are for those particular years. So let's talk about some 2023 planning, things that we'll discuss in meetings with you guys throughout the year. Again, I highlight these. I cover these in most of these meetings and as they apply to you specifically. RMDs, we'll make sure that your RMDs are taken if you're not taking them already. Usually we'll start that process in October if you haven't taken it by that time, and really just need to take it by year end. So we'll initiate it in October if you haven't taken that out already. The other is qualified charitable distribution. So one of the things in the Secure Act, they changed rules with like RMDs for RMD age. They did not change the age at which you can do a qualified charitable distribution, which is age 70 and a half, which is the exact same age that the RMD age used to be. And what a qualified charitable distribution is basically taking money from your IRA or 401k and contributing it directly to a charity, and it reduces your taxable income for the year. The reason why you may want to consider that is with the standard deduction going up so much, most people are no longer able to itemize in their taxes. And so if you're not able to itemize, giving money to a charity may not be a tax benefit to you because that standard deduction may be so high you're getting no benefit. One way around that to get a kind of side benefit, if you will, is to do a qualified charitable distribution directly to a charity. The other is donor advised funds that we've talked about before. Usually you want to use those in a very high income tax year where you want to offset your taxes for that year. So let's say you give $10,000 a year to charity. You plan to do that for the next 10 years. That's $100,000. You have a really high income year in 2023. You could put $100,000 into a donor advised fund, invest it, and then give the money as you wish and to whom you wish, as long as they're a 501c3 for the rest of your life or as long as the money lasts. And the benefit is when you invest it, it can hopefully potentially grow during that period of time, thus giving you the ability to potentially give away even more than that initial $100,000. And then the other is Roth conversions. Again, this may change. So starting tomorrow in the software that we use for financial planning, they will have it all updated. And so it'll reflect the correct RMD ages for those that it will apply to. And that will be something that we'll revisit to make sure that it makes sense. Because given that the RMD age is changing from 73 all the way out to 75 for some, could mean it may not be as much of a benefit because you're having to delay it even longer. And then I'll highlight some changes to contribution limits. So some contribution limits, 401ks increased to 22.5, the catch-up increased. One other thing I'll mention about the catch-up, both for 401ks, IRAs, is that's actually going to be an inflation adjustment. Starting in, I think it's 24, if I'm not mistaken. And that number, that 1,000 that has always been the catch-up for IRAs is actually going to start going up now at an inflation rate. And then health savings accounts for those that do high deductible health plans, that limit will go up as well. All right, so that is a summary of, I don't know how many pages of the Secure Act. One thing told me 4,100 pages. Another thing said 700 pages. So, And Mateo just wrote a great blog summarizing a lot of that. It was just sent out today. So we'll talk about a lot of those nuanced things. There's many other components of that Secure Act. Didn't necessarily relate to the broader audience, but may impact you individually. So when we meet with you, we'll be sure to discuss those particular items.
Questions? Anyone have any questions? Clear as mud.
Well, I have a question. You know, they're talking about the debt and what may happen in the future when we meet the spending limit and things are going to go awry. I mean, what's your take on all of that?
Yeah, so Dana asked about the debt limit discussion. So the government made up a debt limit for themselves, which I guess was an effort to control spending, which doesn't work, right? I mean, they spend whatever they want, and then they just play political games around it to try to score points with voters, I suppose, which is pretty much all they do with anything. And I believe I think it's in June or July that they're going to reach the limit, and then in order for the government to spend more money, they have to raise the debt limit. In 2011, we went through the same thing, and the stock market did fall 20%, and I think Moody's downgraded the debt on the U.S. So, look, the question is it because of the debt limit or the whole discussion about it and the political games that they play, does that mean that, you know, U.S. government debt's not going to be repaid? I mean, and there's no chance of that, right? So I don't think long term it means anything. If there's some short-term volatility associated with it, because, you know, I don't know, Biden said, I don't want to talk to anybody about it. Republicans say it's so important now. You know, we certainly could see some volatility, but I don't think it has any long-term impact. You know, I mean, I think more of the debt question, and some argue that, you know, what we've seen with interest rates going up last year, if there is genuine concern about the government not repaying debt because it's too high and they can't afford it, then interest rates would likely have to go up because people would need to be compensated for the risk that they're taking. And nobody knows if there's a limit to how much debt the government can pile on. I'd also say that when a party is in power, they could care less about debt and spending money, and when they're in the minority, all of a sudden it's the biggest thing in the world. Like, oh, we got to stop spending. So neither party, in my mind, cares about debt limits. And if there's, and you know, I mean, I guess it just makes sense because there really are no repercussions for too much spending. I don't think politician loses their job or not. But the debt limit is just some arbitrary number that they came up with, which I assume they'll adjust. But there could be some, you know, consternation or issues kind of associated with that in the shorter term. I just don't see it as a long-term issue. Any other questions? Does anyone want to know about Jonathan's chart? I love that chart. I thought, come on. I mean, like, you'd think that, like, they spent, it's literally like thousands of pages. Like, you think that they could have spent some time simplifying, like, the tax code or the distribution rules or whatever. They just, I mean, if I asked everyone in this room the rules about RMDs, probably no one, but except for maybe Jonathan and Mateo, could figure them out, right? And then they add them and make it more complex. It's just ridiculous.
Jared.
Yeah.
Given what you said about bonds and stocks, are you starting to overweight bonds in the portfolio now so that?
Yes. Yeah, we have been, Jeff. We've been doing that for 6 months now. So we've been adding to bond positions by selling alternatives. And you know, I would say we're probably like, let me put it this way, we're probably, remember in our portfolios these days, this is a little bit in the weeds, but we are utilizing leverage in portfolios so that we can get like full exposure to stocks and bonds and add alternatives. And we've talked about this in the past. So in essence, we're able to get like a full stock weighting in portfolios and a bond weighting plus alternatives. So we get like the full exposure. So if you looked at portfolios today, for example, a moderate portfolio has about 60%, and 60-40 has about 60% in stock, but it has like 47% in bonds. So we're overweight bonds. And in addition, the bonds that we've bought over the past 6 months have been longer term bonds that would benefit more if interest rates go down. So our view is that alternatives did great in 22. We've transitioned some money. We've sold winners, bought losers, bonds, and now we're overweight bonds. And our thought would be that this year, if it kind of plays out the way that we think it might be, it would be that interest rates go down, bonds go up in value, stocks fall, and guess what we do? We're selling bonds and transitioning more into stock by the end of the year. But we're definitely overweight bonds, and probably, Brandon, I'd say the most overweight bonds that we've been in years. I mean, at least in 10 years, you just haven't wanted to own. I mean, basically, the bonds that we owned for many, many years were just kind of short-term bonds that didn't pay very much, but now it makes sense. The other thing about bonds is there's always a question about how much credit risk you want to take in bonds. So treasuries have no credit risk, and then you can buy like high yield bonds. And we probably are neutrally weighted in terms of credit, but there could be an opportunity if the economy really does poorly to buy more credit-oriented type investments. And I'll just say it again. I've said it at every conference call, WJ notes, if you have cash, please put it in something, okay? We're happy to, we've talked to a lot of you about Flourish. It's a good option for cash alternatives. Schwab has an excellent money market fund. These are all paying 4% or more. If the Fed keeps increasing rates, which they likely are, you could maybe get 5% on a money market. And inflation most likely will be below 5, so you're actually going to earn a real return. So please make sure that you get your cash balances in something. This may be a short-term opportunity. I mean, if rates in a year or two are back down to 1 or 2, then it's gone, but you need to do it now. And I mean, it's real money. We're not talking about just basis points. We're talking about real money. So please engage us and let us know if you have questions about it, but we have some really good, kind of easy options to get in and out of. Other questions? Well, great. Well, we really appreciate everyone coming out today. Thank you all very much.